All right, let's get started. What I'm going to do is walk you through two files. This is for paper 8. Your mind may not be ready for paper 8, but listen, this is stuff that you should know, so it's a good test to see. I'm going to walk you through it and remember this video so you can go back to it. This weekend, I'll be creating the Excel files for everybody. It's going to take me, I don't know how long, but I don't have anything to grade this weekend, so I'm going to be doing it to get everything ready for the rest of the semester. I still haven't figured out how to do paper 9, and we'll just have to talk about that. I'll do some research on that. I think 8, 9, and 8, 9, and 10 are you're going to find are probably easier than 1 and 2 combined, or even easier than just 1 or 2 by themselves. So the papers do get a little more straightforward. One favor I'd ask, if you can remember, it helps me when I do the video, is if you ask a question, if you could mute your video. I like having the video up because that's kind of good to see y'all. None of y'all have your video on, so except for Alan. But if you do have your video on and you want to ask a question, then undo the video while you ask the question. Then I'll have to go through, and if y'all look at the last couple of videos, you might notice like things disappear for 30 seconds, and that's because I'm not allowed to put your video, your picture up there. I'm not supposed to use your voice either, but I'm not really identifying y'all, so I think we're okay on the voice. We'll see if someone has a problem with that, but it takes me a lot of time to edit all of that out. So all right, let's get started. So paper 8, this is, if you're not familiar with relative value analysis, we did the high level last week. If you're not familiar with it, then boy, this is really important that you get exposure to this. This is one of those things that's not covered well undergraduate because a lot of academic professors really don't believe in it. That's why I appreciate Damodaran putting so much time into it, because he used to not cover it at all, and he finally gave in. But it's one of those things that's not covered well, but when you interview for jobs, they just assume you know it because they talk about it so much. So it's kind of one of those scary things where you're not taught it, but you're assumed to know it. And so there's 3 parts to paper 8. We're going to cover the first part, and I'll get you started on the second part, and the third part's the easiest by far. So the first part, you'll see a lot of this in the previous papers, especially the more recent ones. It's very simple, and you're going to think, wow, they can't possibly do this in practice, but we really do. So you're going to say, wow, that's just too simple, Professor Zui. But yeah, it's really what we do. So so I'm going to show you, this is the file I'm going to update for y'all. Y'all should see this in Excel. I'm going to bring the data in from Bloomberg, and I'll go back as far as I can. This is a really big file you might want to take with you out of the class. I have it as paste value so you can work with it. And then this last page is output. So the first page is the Bloomberg formulas. There's a Bloomberg formula there. I'm using the BDH function, which is a really powerful function. I'm bringing in a PE ratio, EV to sales, price to book, and EV to Ebitda. I might do a price to CFO, cash from operations as well. We talked about that. So I might add a couple more in there and see. And that's why the last class I was saying, you got to pick the right relative for your company. So I'm going to give you at least 4, maybe 5 for you to pick from. I'm also bringing in not just your company, I'm also bringing in the sector for your company. So S5CONS, that's the Bloomberg index for consumer staples. So if you're doing a consumer staple, I'll bring that in. So you have something to compare to. What I'm not going to bring in is one of your competitors. If you want to bring a competitor in, you need to email me and tell me that, because I'll have to build this file for your competitor. So I'm not going to do that unless you ask me to. So like if Alan wants to see Carvana or something, if you want a competitor, you got to email me and tell me you want this data for your competitor, because this is only set up to do a company, your sector, and the S&P 500. So it's comparing those 3. If you want anything else, you got to tell me, and I'll probably be doing this Saturday or Sunday, probably Sunday. And so if you're gonna let me know by Friday or so if you want me to pull anything else. All it does is just brings in historical PE ratios on a daily basis. I don't know why I'm doing daily. I might switch that to weekly. We'll see. Daily basis for your company, for your sector and for the S&P 500. You don't have to worry about this page. The next sheet has it all organized, but just to let you see what we have. And what I had to do is I had to put some functions in. Oops, sorry. Hitting the wrong button. I had to put some if functions in. What I'm doing here is I'm using a, well, I think it's on this page, but I'm using the VLOOKUP. So whatever dates I have for Walmart, it pulls that same date in over for your company. I forget where I put the VLOOKUP in, but it's in here somewhere. So somewhere I do the VLOOKUP, so it makes sure everything's lined up on the dates. There it is, VLOOKUP. So I make sure everything's lined up so you get the same dates going against the same dates. I don't know if you use VLOOKUP or not, but VLOOKUP says, hey, go find the first date for Walmart over here, and then go find, and it's actually in the paste value or wherever it's in there, but and then go find that for this index. Go find it for the S&Ps. So it's a pretty powerful way of setting all this up. So let's look at the output and let's talk about what we're going to do. You're going to be amazed how simple this is. So the first one I have is the PE ratio. I don't think I did the graphs for you, so you have to do your own. No, I did do the graphs. The graphs are over on the right. So I did do some graphs for you. But look at the papers, the example papers, and you'll see how some students built their own. So what I did here was I took Walmart's PE ratio. Let me expand this out. This is Walmart's PE ratio divided by the PE ratio of the consumer staples. And this is Walmart's PE ratio divided by the S&P 500. All right, let's see how many of y'all are comfortable with this. If you say something, though, go video blind. But what does 157 tell you? Let me do the first one, and y'all can do the second one, all right? So we can say Walmart is trading 57% rich to consumer staples. All right, y'all see that? Okay. What about to the S&P 500, what would you say? Walmart is what? Sixty-three percent rich. Y'all are all scared to talk now because I'm told you not to have your video on. So they're trading 63% rich to the S&P 500. Now that was back in 1990. What you want to do is talk about today, all right? So you go down to the end. Now this data is kind of old. If you go down, you have to be careful going down to the end because I have these if functions. So you have to just really page that. It's a little bit irritating, actually. You probably have to go down the sidebar until you find it. So this only goes through 2019 because that's when I last did it. So the key is, what are they trading today? So you want to have a statement in your paper, really simple statement. Anybody want to try this one? This is Walmart as of, let's say it's today, it's 1 year ago. What would you say? Walmart is what?
I would say Walmart is trading 17% richer than its sector, and then 20% richer than the S&P.
Yeah, that sounds good. I usually don't say richer. I just say rich too, but I mean, you could say that. I'm just not, I mean, it's perfectly fine. I'm just not used to hearing it that way, but that's fine. But yeah, so Walmart is trading 17% rich to the sector and 20% rich to the S&P 500. That doesn't mean they're trading rich or cheap. So that's the next thing we got to talk about. But you do want to put that statement in there. So the question is, where are they trading today? And then you also want to say versus their history. All right. So that's key as well. So I give you those numbers. So let's look at this. I've got all these numbers up here. So let's look at the top. So historically, Walmart has traded 4% rich to the consumer staples. Today, they're 17% rich to the consumer staples. So this one's a little tricky. Today, they're 12.5% rich to their history. All right, so let me see if I can put all this in there. We're going to do it to consumers. Well, I need more room to type this. Let me just put it all out. Okay, so I'm going to say Walmart is trading 17% rich to its sector, which is 12.5% rich to its history. All right, so you're going to do a relative richness or cheapness to its sector today, whatever the last number is. And you see, you don't have to actually go down to the bottom because I'll bring the number up for you here. So it's trading 17% rich to its sector, but 12.5% rich to its history. Why? Because its median was 4% rich. Now it's 17% rich. So now it's 12.5% rich. All right. Any questions on that? You want to have that statement somewhere in your paper. Versus its industry versus its median. All right. Y'all try writing that down versus the S&P 500, and let's see if we all get the same thing. You've got 10, 20, and 9. So how would you write that? So this is Walmart. You have to do it for your own company. They want to try it? Versus the S&P 500. No takers? That Alan was going to take it because he hit himself.
I was just going to ask, so we're going to compare it to its sector, the S&P 500, and the median of itself, right?
Well, you've got 4 numbers. So you're going to do it to its sector and its median against its sector. Then you're going to do it against the S&P and the median of the S&P. So you really have, 1, 2, 3, 4 numbers to talk about.
Okay.
And the reason I like to do that is part of this is the sector itself may be trading rich or cheap to the S&P 500. And so that can be an influence as well, especially if you're doing tech, right? Tech's going to look really expensive industry. So if a stock that says, well, it's not trading that rich to the industry, well, but the industry is trading really rich to the S&P. So it's going to look okay relative to this industry, but it's going to look really rich versus the S&P 500. So, you have to do both of them. But yes, Walmart is trading 20% rich to the S&P 500, or you can say the U.S. stock market, and 9% rich its history against the market. All right, so they are trading a little bit rich. You notice in the early history, they were trading really rich. So now here, what you want to do is do some graphs. I already have some graphs built for you, but a lot of students like to actually do this as a graph. Graph the two relatives to each other. I think, well, let's look at my graphs. So if you come over to the graphs, over in column V, you got all these graphs. I use the offset function. I don't know if y'all have used that before. The offset function is incredible. Who's used offset function before? Anybody? Victor, have you used that before? Or Alan? No one? The offset function is wonderful because what it tells you is, it's when you do these graphs and then you update it and now you got a whole nother year of data. Now you got to change all your graphs to go another year. Well, the offset function, what it does is it automatically upgrades all your graphs whenever you put new data in. So you don't have to keep updating it. It's a very complicated formula. I could not do it right now because I can't remember it every time I do it. I have to look it up every single time. And it doesn't always work. It's got some tricks that you have to do. But I would definitely put offset as one of your Excel. It might get you a job one day because, boy, I doubt many people know it. Actually, it was... I forget the guy. Oh, I've forgotten his name. It's one of the guys who went on our trip to Costa Rica. But he actually went and looked it up and discovered it. And boy, I was like, wow, that's great. That's really cool. So when I update these to get through November 2020, it's going to automatically change all these graphs for me. It's really pretty incredible. So this is a relative PE graph to the industry. And so here you look at Walmart on a PE basis. They're trading. It's hard to tell that they're trading rich to the industry, but actually the median's pretty low because of these really, really high periods. So I'm using the median. If I was using the average, they're probably trading cheap versus the average, but I use the median because I just think the median kicks out some of these higher ones. So the median's probably coming right around here, and they're trading a little rich to that. All right, so that's the chart, and you'll see these charts in the papers. And here they are versus the S&P 500, and here they're trading a little bit rich to that as well. It's really hard to tell in this paper that what rich is. You've got a lot of time here and a lot of time up here. So when you put the medians probably right around there, it doesn't look quite right, but it's exactly what the chart is. You can actually look and see where I got the data from just through select data. You can see it's coming from, I'm just taking that A through C and just bringing the data in. So that's Walmart on the PE ratio. I'd recommend all of you do either a PE or an EV to EBITDA as one of your main ones that you do. You do a PE, some of you won't be able to do a PE because your firm just goes off the charts. PE ratios can get really skewed. EV to EBITDA might be what you have to do, and you might have to do a little bit of editing to get it to work because your firm, some firms have like PE ratios of 87,000 or EV EBITDA like 87,000. You just got to take that out of the chart because it's going to really ruin the chart. So that can be frustrating. We'll see. I'll be looking at that. That's the advantage of me doing all this, is if I see some problems, I might just fix them myself so you don't have to worry about it because I know I'll stress for the end of the semester. The next one I have is EV to sales. Well, here, as you would expect, Walmart is really cheap on EV to sales because they're a very thin margin business. That's something just to put in your permanent memory. Firms like Walmart and Costco always look cheap on an EV to sales basis. Always look cheap. And so that's the whole reason why we look at them versus their history. So you can see Walmart is trading 57% cheap to the industry. Normally it traded 46% cheap to the industry. So right now it's actually on a revenue basis, it's actually trading cheap. And I think that's because their margins have continuously come down. They look cheaper, but all that revenue they have is not producing as much income as it has in the past. So they just look cheaper on this basis. If I was looking at a Tiffany's or I don't know, Ferrari, they're going to trade extremely rich on the EV to sales basis because their margins are so massive. So that's why it's so important compared to its history and compared to the S&P 500. I mean, these are staple stocks and they're cheap to them. The S&P 500, they're going to be extremely cheap to the S&P 500. So that doesn't mean they're cheap. It's that they should be cheap, just the nature of their business. But here you can see they're really cheap versus the industry. They're almost at an all-time low in the last few years. They've been really cheap. And versus the S&P, really, really cheap. So you'll find this is a problem. On a PE ratio, they look expensive. On the EV to sales, they look cheap. But again, that comes down to margins. If their margins have been declining, they're going to look cheaper on the EV to sales than they do on a PE ratio. It's just a nature, this is basic accounting kind of stuff. All right, y'all stop me with questions if you have any. You can see, if you go out and look at example papers, I probably should have brought up an example paper. You'll see exactly these charts, even the same color coding. Students don't even edit the color code, put it straight in there. One major problem with this is I don't have the company in here. So I probably should have done something like that, just so we know that it's Walmart, right? But anyway, now if you're doing like a Costco, you want to do a Costco versus a Walmart, you could certainly do that. You have to build your own graph, but you could certainly do that and just look at what does the PE ratio for Costco look like versus Walmart or the EV to sales. So if you're doing retail, EV to sales is one you want to do. That makes a lot of sense. The next one we get to, just coming across, is price to book. And this one's interesting to me. This is where you get some really strange answers because they're trading actually cheap on a price to book basis, cheap both to the industry and to their history. They're somewhat in line. They're expensive, the S&P on the price to book, but they're somewhat in line with their history on that. On a price to book basis, this gets a little tricky because, you know, staples, you have to kind of think about, you know, part of the issue is you got a lot of companies buying their stock back, and so that's reducing book values. You also have firms like tech stocks that aren't buying any stock, but they're retaining a lot of earnings. So it's hard to explain why there's such a huge difference, why price to books are so much lower for staples. But it's not my problem because I'm not going to use price to book for Walmart anyway. Now, if you look at some of the example papers, some of the students, if I gave them a ratio, they put it in their paper. That's really not required. So I don't like price to book for Walmart. It doesn't make a lot of sense to me. So I would probably just leave this one out. You can see it's pretty radical in their history, right? If you look back historically, they used to trade really rich to their book value. And so you look at that graph just bizarre looking again. It's somewhat similar to the PE ratio. It's just really hard to explain. And this is part of the problem. You put this in your paper and your boss is going to ask, why is it so different on a price to book basis for the industry versus the S&P 500? And you better have an answer for that because it's a pretty obvious question to ask. And I really think it's what's going on with tech stocks, but not necessarily. They've been fairly consistent. That's the main thing with price to book. They've been really consistent over the last 30 years or so. It really hasn't been fluctuating that much around. A little bit more unstable on the sector side. This says to the industry, it's really to the sector. So, you know, you're probably better off saying to the sector. I'll see if I remember to change that on this, but I don't do it to the industry mainly because I just don't have time. I mean, nothing personal, but there's 11 sectors and there's, I don't know how many industries, and I just don't have time to pull that for every student. So if you're doing this yourself, and if you want to do it yourself, you certainly can use this spreadsheet and go into Bloomberg. You can get more refined, and instead of using a sector, you could do an industry. All right, so there's price to book, and then the last one, I would probably look at the EV to Ebitda and the PE ratio, and I'd probably pick the one that I thought gave me a better graph. Kind of told the story better. So the EV to Ebitda looks really bizarre here. So this one's really strange. They were trading rich on the price to earnings, and they're trading really cheap on the price EV to Ebitda. That's really bizarre. It's hard for me to explain why that's the case. Yeah, I can't even fathom a reason why that would be the case. So and that's a frustration of this, is which ratio you pick gives you a radically different answer. And that's another reason why I think it's really tricky to put all four of these into your paper, because then you're going to have to explain stuff you may not be able to explain. It's going to get really frustrating. So I would stick with, if you're retail, I would stick to either PE ratio and EV to sales, or EV to Ebitda and EV to sales. If my PE ratio looks good, I would probably just stick with the PE ratio. For tech, I like EV to Ebitda. I think it looks really, really good. For tech, it just looks better in your paper. But for Walmart, I might just do PE ratio and EV to sales. And again, you can see they're trading really cheap right now, really cheap right now. You can just see that well, you could even do the industry to the S&P 500. You have all the numbers to be able to do it. But you can just see there's a big difference between this industry and the S&P 500. There could be, I would say it's banking and insurance that's doing this, because, I don't know. I can't explain that on price to book. Maybe, it raises a lot of questions. All right, so what you want to do is get these graphs in there and talk about your firm. Are they trading rich and cheap? Are they trading to their industry, to their history, to the S&P 500, to their history versus the S&P 500? How much more straightforward can you get? All right. If they're contradicting, this is where you'll see a few students at the end of paper 8, they bring everything back together. So they bring their valuations from paper 7. They bring in their relative values from paper 8, and they have an overall summary at the end. Some things are cheap, some things are rich, and they're trying to get a sense, is this stock generally trading rich or cheap? And you're gonna have some contradictions. You might say, wow, I can't take all these contradictions, but if I show you the CFA example, they were doing Merck and it was all over the place. Sometimes they were really cheap, sometimes they're really rich. It's just the nature of valuing stocks. It's really, really tough to do. All right, so this one I think is fairly straightforward. Any questions on this part of the analysis? I'll see how this works. You really can just go to this output page and start pulling. The top part is where you get your numbers. So I gave you the numbers up here. Y'all see how that works. So you can get your numbers right off the top. You don't have to calculate themselves. And then I already did the graphs for you as well. So everything you need is there. It's just a matter of getting the file from me, which you'll probably get this weekend.
I was curious, sir. I know you had mentioned the ratio that you had used with another student that was kind of comparing the price to historical growth, and it's probably more related to tech companies. But is there a way you could actually repeat that and kind of graph that out, maybe using this Excel, or how would you go about doing that if you were to do it?
I'll see. It's tough to do because I have to bring in a lot more data.
Right.
And I could probably part of the problem is that's one where I wouldn't do this rolling history. I'll tell you what I do. If we have time at the end of this one, I'll show you how to do it, or else I'll do it on Thursday, and how you can calculate it yourself. Because you really have everything you need in that first Excel file, and so you can actually create it there. So I'll show y'all either tonight or on Thursday. I'll show you how you can actually calculate it. But on that one, I wouldn't do it. I wouldn't do the rolling history. I'd maybe pull your company and a couple of competitors and just see how they're ranking against other competitors. But yeah,
Okay.
It is a good ratio. It's hard to do it historically, mainly because I'm using 3-year earning or 3-year revenue growth or 3-year earnings growth, either one. And firms only report quarterly, so I'm down to only having quarterly relative values, which is kind of frustrating. Here I got daily data. But I do think it works really, really well for just a one-time graph just to show where everybody is today.
Right.
All right. Other questions on this spreadsheet? So, in the past, you had to go do the spreadsheet yourself and create it. So I'm doing all the work for you. All right. Let's flip to the next one. I'm not hearing any other questions. That's a pretty basic thing. Make sure you understand richness and cheapness, because that's the way we talk in finance. I know it just seems way too simple, but yeah, we're pretty simple people. All right. This is a file I'm going to update for all of you. It's going to be very different for each one of you. Well, if I can combine firms, I will combine them. And so what I'm going to do, what this file does is it brings in a bunch of companies in your industry. This one has 79 companies in it, and it's for consumer staples. So I've got that in there. I sorted it by sub industry. And the reason I did that is because you might actually want to do some stratifying. And a good example is tech. Sometimes in tech, there are certain industries that really mess up the numbers. And I'll show you when we look at the chart. If you see 6 or 7 companies that are all together and they're really messing up the R squared, and you discover they're all semiconductors, then you might just take all semiconductors out and rerun it again. In the investment society, we have a lot more time to work on this, and we actually do stratify. We say, what happens to our model if we take all the agricultural product companies out? Ours goes from 60% to 82%. Okay, well, those companies are really messing things up. So we've had some really good success doing that type of analysis. You're probably not going to have that kind of time. So what I'm going to do is I'm actually going to run the model and make sure you at least have a good, decent starting model. So let me walk you through this. So what I'll do, I haven't decided. You're kind of stuck with what I do. That's kind of the downside of COVID, is I'm going to have to build a model for you. That maybe be the upside for y'all, since I can tell y'all are kind of stressed. But I'm going to bring some data in. The categories I'm going to use, I'm going to bring in data related to turnover and sales. I'm going to bring data in related to margins. I'm going to bring data in related to return on capital, and data in related to risk. I'm going to start this model with no constraints. There are constraints over here, but I'm gonna, no constraints. I'll show you how you can use the constraints here in a little bit. All right. So though, and that's, I'll bring it in that order. So my first few columns are related to turnover. So sales growth. Remember when you talked about sales growth in paper 4, the first thing you did was you talked about their sales growth. So turnover and sales growth. So I've got sales growth in there. I have actual asset turnover in there. I have something here that I really like. I call it asset turnover expansion. And what I do there is I say, compare asset turnover today versus 3 years ago and tell me whether or not their asset turnover is getting better or getting worse. So that's my asset turnover expansion. I've got working capital in there. What I'm doing with working capital is I'm asking, I've got a lot of calculations off to the right. So what I'm asking in working capital, is their working capital getting better? Are they getting more liquid? Or are they getting less liquid? All right. If it's a positive 466, they're getting less liquid. That means their working capital is getting, it's becoming more of a use and less of a source. All right. So there's all the things I have related to turnover. I might, for some of your companies, I might bring in an inventory turnover. I might try that and see if that works. This is where it can get really time consuming for me, because I'll bring in a ratio and then I get a bunch of NAs and I got to take the NAs out and then I got to run the model. And then I discovered that inventory turnover doesn't have any impact on the model. So I just wasted my time. So that's the struggle. Any of you that have been in investment society, you remember how that works. It's just, it's tedious. And now I have to do it for, 20 something companies for our class. So it may be impossible. This might be a 200-hour project. We'll see. I'm going to do my best. All right. The next things I'm bringing is margins. So I'm doing margins. The next thing I'm doing, which I really like this, is Ebitda growth. But the problem with Ebitda growth, if you think about it, let's say a firm's Ebitda was $1 billion 3 years ago, and now it's 1.2 billion. So it's up 20%. That sounds great. But let's say you have another firm whose Ebitda was negative $1 billion, and now it's negative 1.2 billion. Well, they also have 20% growth. Did those sound like the same companies? One went from $1 billion to 1.2, and one from a negative $1 billion to a negative 1.2. So I can't just do the growth rate. So this is a trick. I really encourage you to try this trick because I think it works wonderfully. I think I might be the only person on the globe that does this, but I think this is really cool, except for my students that I keep sharing this with. I want to look at Ebitda growth, but I can't just look at the growth rate, because if I go in from a positive number to a negative number, I get an error. If I have two negative numbers, I got a number that means nothing to me. So what I actually do is I take the change in Ebitda today versus 3 years ago, and I need to divide that by something. Tell me a number that you are absolutely sure will always be a positive number. And I'm going to say sales. Can you think of a company whose sales is negative? Maybe, but I can't. I mean, not too many of them. And so what I'm going to do is take the change in dollars of Ebitda and take that change in dollars and divide it by sales. So if their Ebitda went from negative $1 billion to negative $200 million, it's still negative, but at least it improved $800 million. And I can look at that growth. And that's what I'm doing there. All right. I do a good old Ebitda margin, pretty simple, very straightforward. And then the same thing there, I do an Ebitda margin expansion. Is their margin better today than it was 3 years ago? All right. The only reason I have 2018, 2017, all it's asking is, I did this some years ago. I'll be using 2020 and 2019. All it's asking is if 2020 is available, use 2020. If not, use 2019. That's all that formula is doing. All right, so there's my margin components. And then I'm going to do return on capital. Remember, return on capital, you have asset turnover times margin. That's a good ratio. I got EVA spread. That's a good ratio. I also did an EVA expansion. Is their EVA getting better or worse? What do you notice I don't have in here? I don't have return on equity. Why don't I have our return on equity? Well, you all saw it in your numbers. You get a lot of NAs. You get a lot of crazy data. So I decided to leave that out. I might bring return on invested capital in, but I really don't think I need to, because to me, ATO times margin is really close to return on invested capital. It's almost already there. So I've got 3 things on capital, return on capital. And then the next thing I have is risk factors. I'm using that probability of default. You use that in paper 4. I'm using debt. I'm using net debt. Net debt can be a little tricky. I might actually change that to gross debt. Net debt is debt minus cash, and so you can get some negative numbers, which I don't like, but we'll see. I guess that's good. But net debt to EBITDA, the problem with a negative number, if debt minus cash is a negative number and EBITDA is a negative number, I think Bloomberg just gives you an NA. I don't think they calculate that because that'd be a really bizarre number, right? But so I don't like net debt. Gross debt just takes debt and divides it by EBITDA. It doesn't subtract out the cash. But I've got a debt number in there. I like bringing the volatility of the stock in. I know you're using beta and all that, but for tech stocks, the volatility of the stock is actually a pretty important input. Short interest ratio, I like to use that for tech stocks. Do y'all know the short interest ratio? Anybody familiar there? So short interest is investors short stocks when they think they're in trouble. And you can take the ratio of shorted stocks versus the total outstanding. And that gives you the short interest ratio. And the thought is firms with a high short interest ratio, it could be good news or bad news. You usually think it's bad news because there's a lot of people who think the stock is going down. You could do the same thing with the put call ratio. I don't know if you've ever, you might look that up, the put call ratio. If more investors are buying puts on the company than calls, that's another indication there's strong bias that this stock's going down. Usually, if a lot of people think the stock's going down, there's a good chance it's going to go down. However, there is another side to this. A stock with a lot of short interest, if the stock price actually starts going up, you got a lot of people having to cover their shorts, and that can actually cause the stock price to go up. So I'm not sure how valuable this is. Dr. Misra hated that we were using this ratio. He thought it was way too short term. He doesn't like it at all, but I put it in there. So we'll see. Something else I could put in here that's not in here. I'm not sure exactly where it goes, but I could put a momentum indicator in here. I could take their current stock price over the 50-day moving average. So we've tried that before. It tends to work really well for tech stocks. So I could put that in there. I'll see. Maybe I'll do that with tech stocks. One thing I do is if I cannot get a good model, I just keep trying stuff until I can find a good model. And tech is the worst. It is so hard to find. And the reason tech is so difficult is the stock market seems to not care about anything on history for tech stocks. It's about the only thing they care about is the future. Actually, for tech stocks, I usually actually put in their expected growth in earnings as one of the inputs because that's about all I can find that really works. So it's tough. Tech stocks are really, really hard to get. Most other sectors work okay. Consumer staples and discretionary work really, really well. But so you may not get exactly this list, but the key is that you look through it. I think what I'll do is if I pick something that might be a little unusual, I'll give you at least enough discussion so that you can Google it, so you'll be able to understand it, so you can explain your model. The key is when you explain your model, you only have to explain the parts that actually got allocated in the model. So I might have 20 things in the model, but maybe only 7 of them actually get allocated anything. So you only have to talk about 7. So let's talk about, well, the last 2 are the valuation measures. I'm using here EV to EBITDA and EV to sales. I might put all 4 in. I might put EV, I might put 5 in there. Just let the model tell me which one's the most important. The problem with me using too many of them is, again, I start getting a bunch of NAs. If one of your firms has an NA, I have to kick that ratio out because I can't kick your company out, obviously. So NAs are a huge problem with this if a firm just doesn't have it. You can get NAs on EV to EBITDA. If a firm has no earnings, they have negative earnings, they will not get a ratio. One reason I love EV to EBITDA is you almost never get any NAs because firms don't have negative sales. So I might put 4 or 5 of them in there, but I might get so irritated I can't do it because I get too many NAs. So what are we doing here? So we're going to use everything over here. All of these factors here, we're going to use them to try to forecast these factors. Remember, you're going to use the fundamentals and the risk to forecast the valuation. My fundamentals are turnover, margin, return on capital, and my risk, you just saw my risk factors. I'm going to use those to try to forecast these valuation measures, okay? Now, how am I going to do that? Well, over here, you can see we have we have 15 factors. So 15, 1/15 is 6.67. So I'm going to start, and this is what I'm going to send you. So this is really, really important you understand this part of it. I'm going to send you an equal weighted model. Every factor is going to be allocated 6.67%. Or how many factors I have? I've had 10 factors, so it gets 10%. And then on the valuations, I'm going to do 50% in each one of those. All right. So my margins, turnover, return on capital and risk, they add up to 100%. And my EV, the EBITDA, and EV, the sales, that adds up to 100%. And so I have an equal weighted model, and that's what you'll start with. And my R squared is pathetic. It's only 14%. So we want to get that R squared higher. So how do we do that? Well, what we're going to do is we're going to use Solver, Excel Solver. It's already set up. You do have to add Solver to your computer. If you don't know how to do that, you can probably Google it, how to add in Solver on Excel. I'm sure there's a million Google sites that tell you how to do that. All right, so before I do that, let me explain how this model works. It's a ranking model. So let's look at 3-year sales growth. Let's look at Molson Coors. I'm doing a ranking model. I'm taking Molson Coors' 3-year growth rate, and I'm comparing it against all the other companies. And then I'm doing comma 0. What comma 0 says, the firm with the highest growth should be ranked number 1. Molson Coors had a growth in revenue of 53%. Y'all see that? 53%. That's a pretty high growth. And it's an average. So they're averaging. It's not like 53 over 3 years. They're averaging 53% a year. So they're number 1. This company here, Alico, they're last place. Their growth in revenue was negative 17.73%. And again, that's an average over time. I don't know what Alico does, but I don't want to own them. So they rank last. If you do comma 0, the one with the lowest number gets ranked last, with the highest number gets ranked first. All right. Let me come over here to the probability of default. You notice here I'm using a comma 1. So a firm that has a high probability of default, they're going to be ranked last place, and a firm with a low probability of default, they'll be ranked first. So everything good is better gets ranked first, bad gets ranked last place. So if a higher number is bad, then they get ranked lower. If a lower number is bad, they get ranked lower. If they have a low number, so it's all using the ranking function. The ranking function is really, really cool to use. You notice on capital management, it's comma 1. Because if they're becoming less liquid, I'm scoring them much lower. All right, so Alico actually does well on capital management. The 2 doesn't mean they have their capital management becoming more of a use. It means that their capital management becoming more of a source. So they rank really badly on sales growth and turnover, but they actually do pretty well on capital management. All right, so I'm ranking all of these. At the very, very, very end, in column AL, I'm just doing a weighted ranking of all of those factors. It gives me a weighted ranking, all right? And you'll just see where they all rank. Molson, Boston Beer Company, Molson, the beer companies are doing great. Another one, man, alcohol is just doing great in our model. The one that always does the best is Monster. None of y'all did Monster this semester. I was kind of disappointed. Now look at Monster. Monster weighted rank is 19 out of 79. You say, well, that's not all that good. But the only way they could be ranked number 1 is if they were number 1 all the way across. And no one's going to be ranked number 1 all the way across. So their weighted rank is 18.93. That's pretty good. So what I do over here in column AN is I re-rank it and say, based on these weighted rankings, where did they rank? And they're number 1. There, that 18.93 is the best ranking out of all of these weighted rankings. All right, so they're number 1. Monster's number 1. Why didn't one of y'all do Monster? We had Monster last year. Interesting paper. I don't know why anybody drinks that stuff. I've never had one of those before, but the model loves it, probably because of really strong growth. Same thing on valuation. Now be careful on valuation. You might think a high PE ratio would be bad and a low PE ratio would be good. But that's not the way this is set up. The highest PE ratio is ranked number 1. The lowest PE ratio is ranked last place. The reason for that is, just like we're seeing here, let me go back down to Monster because it makes a lot of sense. Monster is our best company. We think it's the best, but they're also the 4th most expensive. So you see why I want those 2 columns like that, all right? I want most expensive to be ranked number 1. So what's the most expensive company here? There it is right there. Fresh Pet. Our model doesn't like it, but the stock market loves it. I don't think that Fresh Pet is, I know there's a company that was like doing home delivery of pet food. I heard a podcast on that. It sounded pretty interesting. People hate buying dog food because it takes up so much room in your grocery shop cart. You can't buy anything else. And then plus people have stupid conversations with you in line because you buy that, 50-pound bag of dog food. Suddenly they're going to ask you questions about your dog. And you really don't want to talk to them. So people want to order food at home. So maybe that's what's going on. It's a new company, doesn't have much history, and that's why they don't work. So this approach will kick out some really good companies, no question. So we're not looking for perfection here. What we're trying to do is just understand your company in a general sense. There may be offsetting circumstances, but we don't have the 40 hours a week, 50 or 60 hours a week, 52 weeks a year for y'all to work on this. So we're gonna have to cut some corners. All right. Now, a 14% R squared is horrible. So what can we do to fix that? So what we're going to do is we're going to let Solver come in here. We're going to tell Solver to change all of these weights to get us the highest R squared we can. So under Solver, so first of all, how do you add Solver? You do File, Options. Hopefully y'all know how to do this. I'm probably telling y'all. And then go to Add-ins. And when you click on add-ins, nothing happens on my computer because my computer is really slow. You click on add-ins, and then at the very, very bottom down here, you have Excel add-ins. You might not remember this, but you can watch the video. Excel add-ins, you just say go, and make sure I just click on everything. I know it takes a little longer for Excel to load when you do that, but I use the analysis toolpack all the time. So I use all these. All right, so I've already got Solver loaded, but that's how you do it. You know you have it when you hit the data button and Solver is over there, okay? The nice thing for you is when I send you this file, Solver is already going to be set up. So you don't have anything else to do. So when I click on Solver, I've already got it set up. So Solver is going to maximize that, not the R squared, actually do it on correlation. Remember, R squared is just correlation squared. Remember that from your stats class. I like to maximize the correlation because remember, correlation could be negative 0.9. And that would give you a positive R squared of 81%. So that's the reason I maximize on correlation. So I don't get a negative 0.9 correlation. By changing what? Well, changing all those percents. Then the fundamentals need to add up to 100%. The 2 valuations need to add up to 100%. I'll talk about these other 4 constraints. Then I just click solve. And Bill Gates starts working on it. Whatever he's doing, I think it's pretty amazing. These models can do this. And it's working on it. I don't know how long it would take. If you're using a Mac, you might try it a couple of times max. My understanding of Apple is they added Solver in kind of last second, and they really didn't do it justice. And so I've been on some Macs where the Solver can take forever. Maybe Apple has fixed that since then. Hopefully, it can take a little bit of time. Anytime I have something going on video-wise, my computer's a lot slower, but it's working. It's doing the best that it can. So questions while I'm doing that, because I'm going kind of fast. I mean, essentially all you have to do is load this file and run Solver. So, I'm giving you the details so you're not, because I'm hoping you're going to use this paper in an interview and they're going to ask you about this. So you don't want to hand them your paper and they ask you about it and you're like, have no clue what's in the paper. It's like my professor ran that for me. That's not going to be a good answer. So you want to make sure you understand what I'm doing here. Boy, I don't know how long this is going to take. I'll just let it go. If it takes too long, I'll break out of it and I'll load up the original file. Questions?
So basically, we would want to look for stocks that were ranked very differently from the market.
Yeah, your ideal was you rank it number 1. And it's the 79th most expensive. Now, if that happened, you'd say, okay, there's something wrong with my model. Then you'd be really, really worried, right? It's like, oh man, what's going on with my model? You're not going to find that, but the way we do it, in fact, in the investment society, boy, come on, Bill Gates, you can do it. There it goes. All right, I found a solution. So there we go. I got my R squared up to 78%. I don't know why it's not higher than that. I've gotten it higher than that before, but there's my R squared. So when we look down through this, the way we do this in the investment society, so look at here, Brown-Forman, our model loves it. The stock market loves it. Constellation, our model loves it. Stock market loves it. Loves alcohol companies. Great. This one looks a little better. We actually bought Procter & Gamble. Our market loves it. Our model loves it. It's expensive, but it's cheaper than our model thinks. We rank it third. It's ranked 11th. Colgate looks even more interesting. Colgate was on our short list, but we didn't buy it. But we ranked it fourth, and it was 14th overall. If I can find a good example. Here's Conograd. I have no idea who that is. Ranked 42nd. They're the 27th overall ranked. That would not be a good company at all. Hershey's one of the companies we bought. We ranked it 5th. It was 13th overall. Hormel Foods, we used to own them. We sold them when their ranking kind of deteriorated there. Here's a good looking company, Smuckers. We actually looked at Smuckers. We ranked it 19th. It's 28th overall. Wow, here's one. There's that Fresh Pet. We ranked it 44th. It's second overall. Would you have the guts to short that stock maybe? Estee Lauder is a company we looked at, but it looked a little expensive to us. Even this stock like here, and actually, if you look at that company, USANA Health Services, Health Sciences, Herbalife. One thing we notice is and I don't want to step on anybody's toes, but the multi-layer, what do you call these?
Multi-level marketing.
Multi-level marketing firms look really good in our models. We kicked them all out. We said, we're not going to do Herbalife. I know a guy that sells Herbalife, and it's just like, boy, if he's working for that company, if your parents are working for it, it's fine. It's a wonderful company. I just happen to know their worst salesperson, and just wouldn't invest there. But anyway, so we kicked them out. Another thing we found that did really well in our model were educational companies, like Phoenix. And we didn't like them at all because of what's going on. With Trump getting elected, we probably should have done it because they did better under Trump. But there's a lot of people saying they want to take care of student debt, and these companies are under a lot of stress. So there's some whole groups of companies we kicked out. We just didn't want them. Monster, again, we ranked it first, but the market had it third. Not a real great opportunity there. So that's what we're looking at, all right? I don't want to rerun the model, but I'm going to come back over here, column X and Y, WX and Y. And I'm going to look at this. These are consumer staples. Consumer staples should be heavily weighted toward margins, no question. If I were doing tech stocks, I'd want it heavily weighted toward turnover and sales. If I were doing banks, insurance companies, I wanted it heavily weighted toward return on capital. All right, it comes back to what we talked about last class about, which ratio do you pick? But I do want something in turnover. I want to have at least 10% in turnover. I might want at least 40% in margins. I might switch these two if I were doing tech. Return on capital, boy, I want something return on capital. Allocated 0 there. So I'm going to put 20% there. I like to have at least 20% in risk. So you can actually look at these things and give your own criteria to them. All right. So I'm not going to rerun the model, but if I rerun the model, what's going to happen to my R squared? It has to do what? It has to go down, right? It can't go higher. If you're going to put constraints on it, it will have to come down. If it goes from 78 to 76, no big deal. If it goes from 78 to 20, then yeah, go back and undo one of those constraints because you're really, it's messing with your model. But there's some other things you can do. So here's a chart, and this is a chart you want to put into your paper. So I'm doing the ranking like right here. That one right there, that is Monster. You see that 1 and 3? We rank it 1. So down here is how we rank it. So the further west you are, the more we like it. The further south you are, the more expensive it is. So if Monster was the cheapest stock, it'd be sitting right here. Y'all see that? We rank it number 1. It was the 79th. Monster would be sitting right there. Another stock, if it was right here, it's the most expensive. We rank it last, be right there. So cheapest is in Seattle. Most expensive is in Miami. Okay. And then I circle the ones that we put on our short list. Now, what you want to do is to mark some competitors. How do you do that? I don't know how to do that in these graphs, but I'll show you how I do it. So I'm going to take off the, I'm going to reset my axis. So you have to reset your axis and then go back to data. And let's pretend like I'm doing, let's do Monster, all right? Let's pretend like I'm doing Monster and I don't know where it is. I can't find Monster. So what I do is I go over to those 2 columns where I'm doing my graph. I'm doing my graph off of columns AN and AO, and I'm going to go to Monster, and I'm going to add 1,000. And I go back to my chart. Can y'all tell where Monster is? Right there, right? So I'm going to go down here. I'm going to take Monster. I'm going to change it to red with no border. And that's the marker options. That's good. The size, I'm going to take the size up to 10 or 11. Well, I was a little overdone there, but that's okay. Then I go back over here, take that 1,000 out, go back to my chart, and now you've got Monster sitting there. And I went to 11. That was a little much. I should have probably just done 7 or 8. And here you can do add a label. When you add the label, you can just go in there and, well, you have to get the label. Boy, that's tough stuff. All right. Format data label. Nope. There we go. So it's really tough. It can be really tough to get it. Let me go back to my my scaling here. I only have 80 companies, and so you don't want your graph to be more than the companies you have. You don't want white space over here. So if I have 80 companies or I have 79 companies, I'm going to stop it there. All right. So you have to somehow get to this number, and it's just not letting me do it. Let me try it again. Sorry, guys. 11 is just way too much. Let's try 8, 7. That looks good. And then I'm going to format label. Hit the F2 or something. Come on, let me, Bill Gates. Gotta let me get in there, man. And then I don't know what their ticker is. Anybody know the ticker is MED? I can't remember, but I'll put that in there. What is their ticker? MNST. All right, so I got it. So now I've got that in there. And I got my company marked. I'll probably bring it back over here. Format. Yeah, come on, Bill Gates. You can do a lot better than that. I don't like how they do these graphs. It's just so hard to do this. And just get it back over there. So it's a little bit, y'all have to figure it out. Do your best. But you do want your company on the graph. You might want another competitor, and you do the same thing, just find another competitor. So Monster, if that was my company, they're trading cheap, but not all that cheap. Slightly cheap. So it's a company our model likes a lot, and it's a company the stock market likes a lot. So you can see why I picked these 7 companies on our short list. Look at buying, because and the way we did this in Investment Society, we wanted them at least in the top half, the top 40. So we wanted everything from 40 to the left, and then we want them as far from the line as possible, because the further away you get from the line, the cheaper you are relative to the market. Like this stock, we ranked it 21st, and it's the 46th most expensive. All right. Questions on this chart? I know some of you are not fully understanding this because this is a lot all at one time. So questions on this chart. So I won't be marking companies. You'll have to mark your own companies. I will put your company on the front top line, or at least one of the top lines, so it won't be so hard to find. I won't have companies circled like this. These will all come out. And then you just put this into your paper. Now, one thing you can do, if your R squared is not good, one thing on the R squared is if you see some real outliers, if you go find those outliers like this one, 44 and 2, if you go find those outliers, see if I can find it. Where is 44 and 2? Come on, come on. Oh, there it is. That was the one we were just talking about. If I just take it out of the model, I can go back and look at my R squared and look at that. Taking that one company out took my R squared out from 78 to 82. So when you have outliers, it tends to mess up the chart, and you can see, you know, now Monster moved closer to the line. So I'm building all this for you. So the key is, can you explain this graph? Can you run solver, explain this graph? The last thing I'll show you, we're running out of time here. The last thing I'll show you is the question of what did the model use? And so you just come over here to column U. It put a little bit in the sales growth, put a little bit in the capital management, put a whole lot in gross margin, which is always good for consumer staples. And I'll just tell you now, anytime that EV to sales is your valuation tool, you always want gross margin to have a high allocation. It's extremely important because Walmart and Costco will always look cheap on EV to sales basis, but they have really thin gross margins. And so you got to put those two things together. Growth in the growth in EBIT margin, 45%. That was really important. Margin expansion was important. Nothing on capital, return on capital. So if I put those constraints in there and allocate something there, probably the EVA. Put 23%. Now you might say, why didn't it put anything in these other ones? Well, remember this Bloomberg default probably includes debt to EBITDA. So it's already in there. So there's no reason for it to do that again. I like this. I actually like this ratio because it does include so many things in one ratio. I got it all covered. So that really helps me a lot. And then as we expected, it put 100% in EV to sales. We just know that's going to happen with consumers. And I've seen it do it with tech stocks as well. It's possible with tech stocks to get EV to sales. I'll prefer EV to EBITDA for tech stocks, but it can do EV to sales. All right. So you've now seen two parts of the of paper 8. Thursday, what I'll do is I'll answer Victor's question about the PEG ratio using historical growth. I'll do an example of that. I'll do it with your company, Victor, since you asked about it, and show you how you can pull that numbers. And then I'll talk about the last thing you need to do for paper 8. And then we'll look at some student examples so you can see it's exactly this. So I'm hoping you feel more comfortable at paper 8. It might seem a little overwhelming because of all these files, but when you take in consideration I'm doing 90% of the work, it should relieve some of the stress for you. All right, so final questions y'all have on paper 8.